Central banks just bought more gold than any year in recorded history, not by a small margin, by a margin so large it broke the previous record set just 12 months ago, which itself broke the record set the year before that. 3 consecutive years of record-breaking central bank gold accumulation, and nobody on mainstream financial media is asking the only question that matters: why? Not why are they buying gold? That answer is obvious. The question is, why are they buying at this pace? Why now? Why this urgently? What do the institutions that literally control the world's monetary systems know about the future of those systems that they're not saying publicly while they quietly convert their reserves from paper currencies into physical metal at the fastest rate in human history? Actually, before I get into the data, I want to run a quick experiment. Drop a comment right now, just a number. What percentage of your personal savings is in gold right now? Be honest. 0%, 5%, 20%? I want to see where this audience stands before you, see what the central banks are doing with their reserves. Because the gap between what they're telling you to hold and what they're choosing to hold themselves is the entire story. Drop your number, go. All right, now let me show you the data that central banks don't discuss at press conferences but can't hide from their own filings. And by the end of this video, you might want to revisit that number you just posted. Here are the raw numbers. In 2024, central banks globally purchased over 136 tons of gold. That's the highest annual total since records began being kept by the World Gold Council in 1950. That's 74 years of data, and nothing comes close to the buying pace of the last 3 years. 2022 was 1,082 tons, 2023 was 137 tons, 2024 was 1,136 tons. 3 consecutive years above 1,000 tons for the first time ever. The previous record before this streak was 656 tons in 2018. They nearly doubled that and then kept accelerating. But here's what's really going on beneath that headline number, and this is the part that should make you pay very close attention. The official numbers only capture what central banks report. Not all central banks report their purchases transparently or promptly. China's People's Bank reported adding 225 tons in 2024. But cross-referencing Chinese customs data gold imports through Hong Kong and Shanghai, gold exchange withdrawal data suggests actual Chinese sovereign gold acquisition was closer to 500 tons. That's more than double the official number. And China isn't the only country where the official figures don't match the observable flow data. The real number isn't 1,136 tons. Multiple independent analysts, including those at the World Gold Council itself, have suggested the actual figure, including unreported purchases, could be north of 1,500 tons. That's approximately 30% of total annual global mine production being absorbed by central banks alone, before a single jeweler buys an ounce, before a single ETF adds a bar, before a single retail investor purchases a coin. Central banks are taking nearly a third of everything that comes out of the ground every year. Here's what I'm going to do in the next 16 minutes. First, I'll show you which central banks are buying the most aggressively and what the pattern of their buying reveals about what they're preparing for. Second, I'll walk you through the 3 specific monetary shifts that central bank gold buying at this level historically precedes. Because this is not the first time in history that central banks have scrambled for gold at record pace. It's happened before, and what followed changed the global financial system. Third, I'll show you exactly what this buying means for gold prices, and why the floor under gold is now structurally higher than most analysts understand. Everything I'm about to show you comes from World Gold Council data, IMF International Financial Statistics, central bank balance sheet disclosures, customs and trade data from 6 countries, and COMEX Vault reports. Links in the description. Every number is verifiable. I'm not asking you to believe me, I'm asking you to check the filings yourself. And I should tell you, I've been tracking central bank gold flows for over 8 years. Every quarterly report, every IMF filing, every anomaly between official numbers and observable trade data. In 8 years of watching this, I have never seen buying this aggressive, this sustained, and this globally coordinated. Not even close. What's happening right now is historically unprecedented, and I don't use that word casually. Let me show you who's buying, and why the pattern matters more than the total. China has officially added over 300 tons to its reserves since it resumed reporting purchases in late 2022. But, as I mentioned, the observable data suggests the true number is far higher. China's stated gold reserves are now approximately 2,264 tons. That sounds like a lot until you realize it represents roughly 4.9% of China's total foreign exchange reserves. Compare that to the United States at 69%, Germany at 72%, France at 68%, Italy at 66%. China's gold allocation relative to its total reserves is tiny by Western standards. If China even moved toward 10% allocation at current prices, they would need to purchase approximately 3,000 additional tons. That's nearly 3 years of current global mine production absorbed by a single buyer. Poland bought 130 tons in 2024, making it the largest European buyer. Poland's central bank governor publicly stated their goal is to increase gold's share of reserves to 20%. They're currently at 14.7%. A country that shares a border with an active war zone is accelerating gold purchases and publicly announcing higher targets. That's not portfolio diversification. That's preparation. India purchased 73 tons officially in 2024. Turkey added 68 tons. Czech Republic increased its holdings by 20 tons, representing a 30% increase in a single year for a small central bank. Singapore, Iraq, Qatar, and several other nations all added meaningfully. The buying is not concentrated in one region or one political bloc. It's global, every continent, developed and developing nations, NATO members and non-NATO members, countries that agree on virtually nothing else in geopolitics or economics all agree on one thing right now. They need more gold, immediately, at any price. That's not a trade, that's a signal. Think of it this way. When one person on your street starts buying canned food and water, you might think they're being cautious, maybe a little paranoid. When your entire neighborhood starts buying canned food and water at the same time, you should probably stop judging them and start asking what they know about the weather forecasts that you don't. Here's what I want you to ask yourself honestly. If gold is just a barbarous relic with no role in the modern monetary system, like many mainstream economists still insist, then why are the institutions that run the modern monetary system buying it faster than at any point in 74 years of recorded data? Why are the people who print the currencies accumulating the one asset that competes with those currencies? Why are they prescribing paper for you while hoarding metal for themselves? That question answers itself. They're the doctor telling you smoking is perfectly fine, while they hide their own nicotine patches in the desk drawer. They create the currencies. They manage the currencies. They publicly defend the currencies. And then they take their own reserves and convert them to gold at the fastest pace in human history. That's not what confidence looks like. That's what preparation looks like. But don't take my word for it. Let me show you what happened the last 3 times central banks bought gold at anywhere near this pace, because the pattern that followed is consistent and it's significant. The first precedent, 1967 to 1971. In the years leading up to Nixon closing the gold window, central banks, particularly France under de Gaulle, were aggressively converting dollar reserves into gold. They were redeeming dollars for gold at the U.S. Treasury at the fixed rate of $35 per ounce. France alone repatriated over 3,000 tons of gold from U.S. vaults. Other European nations followed. The gold was flowing from west to east across the Atlantic as fast as ships could carry it. What were they seeing? They were seeing the United States running persistent deficits to fund the Vietnam War and Great Society programs. They were seeing more dollars being created than gold existed to back them at the fixed rate. They knew the math didn't work. They knew the system would break. They didn't announce this publicly at press conferences. They simply converted their paper into metal as fast as the system would allow. In August 1971, Nixon closed the gold window. The dollar was devalued. The fixed rate of $35 per ounce was abandoned. Gold subsequently rose from $35 to $850 by January 1980, a 2,300% increase over 9 years. The central banks that had accumulated gold before the system broke preserved and multiplied their reserves. The central banks that held dollars watched their purchasing power collapse by over 90%. The scoreboard, central banks that accumulated gold before the monetary reset won. Central banks that trusted the paper system lost. Let me keep that count running. Now you might think that was a one-time event. Unique circumstances, Cold War era politics, a fixed exchange rate system that no longer exists. Different world entirely. The second precedent proves it wasn't a one-time event. And this one is even more revealing because it shows what happens when central banks ignore the lesson. When they sell gold instead of buying it, the punishment was brutal. 1999 to 2009. In 1999, the Bank of England under Chancellor Gordon Brown announced it would sell approximately 400 tons of gold, half of Britain's reserves. The announcement itself crashed the gold price to $252 per ounce. It became known as Brown's bottom because gold literally bottomed on the exact date of the British sales. Multiple other European central banks followed with coordinated sales under the Washington Agreement on gold. They sold because they believed gold was a relic, outdated, unnecessary in a modern financial system built on dollar hegemony sophisticated derivatives, and the assumption that Western financial engineering had permanently eliminated systemic risk. They looked at gold and saw cost, storage fees, no yield, opportunity cost of not holding dollars. Then 2008 happened. The financial system they trusted nearly collapsed overnight. Banks failed, governments printed trillions, currencies were debased through quantitative easing on a scale never attempted before. And central banks in emerging markets who had been net buyers during the exact period when Western central banks were selling found themselves holding an asset that tripled in value while paper assets imploded around them. Gold went from $250 at Brown's bottom to over $900 by 2011, a 654% rally. The Bank of England's sale cost British taxpayers approximately $20 billion in lost value calculated conservatively. The central banks that bought what England was selling during those years made generational returns that funded real economic development in their countries. Scoreboard update. Central banks that accumulated physical gold before monetary instability won. Central banks that sold gold and trusted paper lost. That's 2 for 2. The pattern is consistent across different decades, different political systems, and different monetary frameworks. 2 precedents. Same pattern, same outcome. Central banks that held gold won. Central banks that sold gold lost. And now the third precedent isn't history. It's happening right now, in real time, and the trigger is something that changed the calculation for every central bank on Earth overnight. Since 2022, central bank gold buying has exceeded 1,000 tons annually. This acceleration began immediately after the United States and its allies froze approximately $300 billion in Russian central bank reserves held in Western financial institutions. Following the invasion of Ukraine, that single act changed everything. It demonstrated that dollar-denominated reserves held in Western banks are not truly sovereign. They can be frozen, seized, weaponized, redirected. If you are any country that might ever find itself in diplomatic disagreement with Western foreign policy, and that's a very long list of countries, your dollar reserves carry a risk that didn't exist before February 2022, or more precisely, a risk that existed theoretically, but hadn't been demonstrated at that scale against a G20 nation. Gold in your own vault on your own soil cannot be frozen by a foreign government. It cannot be seized through the SWIFT system. It cannot be sanctioned through executive order. It cannot be weaponized as a diplomatic tool. It is sovereign in the truest sense of the word in a way that no paper currency reserve held in another country's banking system can ever be. And since February 2022, the countries that recognize this reality have been converting paper to metal at a pace that makes even the 1960s accumulation look modest by comparison. Scoreboard final update. 3 precedents. 1960s accumulation before the Nixon shock. 2000s accumulation before the financial crisis, 2020s accumulation before whatever comes next. In every single case, central banks that accumulated gold before the monetary disruption preserved and grew their wealth. Central banks that held paper or worse sold their gold lost, 3 for 3. The pattern is unanimous across 57 years of monetary history. The lesson could not be clearer. Now let me show you what this buying means for the gold price structurally. Because most analysts are still modeling gold prices using supply and demand frameworks that don't account for what's actually happening in sovereign acquisition. Global gold mine production is approximately 3,600 tons per year and has been essentially flat for the last 7 years, despite record high gold prices. Geological discoveries of major new deposits are declining sharply. Average ore grades are falling, meaning more rock must be processed to extract each ounce. Permitting timelines in major mining jurisdictions are extending to 10 to 15 years. New mines take 15 to 20 years from initial discovery to full production. There is no supply response coming that can offset current demand growth in any meaningful time frame. The gold that's available each year is the gold that's available, and it's not growing. Central banks are now absorbing approximately 1,200 to 1,500 tons of that annually, accounting for unreported purchases. That's 33 to 42% of total mine supply going to a single category of buyer, a category that doesn't sell into weakness, doesn't trade on momentum, doesn't get margin called, doesn't panic during crashes, doesn't respond to analyst downgrades, just accumulates steadily, relentlessly, month after month regardless of price. Now add jewelry demand at approximately 2,100 tons per year. Technology demand at 300 tons for electronics, semiconductors, and medical devices. ETF and retail investment demand fluctuating between 200 and 800 tons, depending on market conditions. Total demand routinely exceeds 4,800 tons against 3,600 tons of mine production, plus roughly 1,200 tons of recycled supply. The structural deficit is approximately 200 to 400 tons per year, and central bank buying is accelerating into that deficit, not moderating. They're not buying because the price is low, gold is at all-time highs. They're buying because they believe the price is going significantly higher, or more precisely, they believe the purchasing power of the currencies they're selling to buy gold is going significantly lower over the coming years. When the buyer of last resort is also the buyer of largest size at record prices, that tells you something about where they believe the price floor is. And it's not below current levels. Quick pause. If you've made it this far, you now understand why central banks are buying gold better than 95% of financial advisors, who will tell you gold doesn't pay dividends. and therefore isn't worth holding in a modern portfolio. Those advisors are looking at yield. Central banks are looking at survival. Those are very different analytical frameworks designed for very different time horizons. And right now, the institutions with the longest time horizons and the most complete information are choosing survival over yield. That should tell you something. But here's the thing. Central bank buying is still accelerating, not plateauing. China's true allocation is still under 5% when it likely needs to be above 10%. Poland hasn't reached its stated 20% target. India is barely scratching the surface of where its reserves need to be. The BRICS nations collectively have announced formal interest in a gold-backed trade settlement mechanism to reduce dollar dependence. If even a partial gold backing of trade flows materializes, the demand for physical gold at sovereign levels could double from current records. Next week, I'm breaking down the specific vault movements, showing where gold is flowing from and where it's flowing to. Western vaults in London and New York are draining. Eastern vaults in Shanghai, Beijing, and Mumbai are filling. The directional flow tells you everything about which side of the world is preparing for what comes next. Subscribe. Hit the bell. You do not want to miss that one. All right, back to what this means for you practically starting today. Now, I know what some of you are thinking. Central banks have different mandates than individual investors. They're managing currency reserves, geopolitical risk, and monetary sovereignty. That has nothing to do with my retirement account or my personal portfolio. I should follow my financial advisor's standard asset allocation model, not try to mimic what the People's Bank of China is doing with sovereign reserves. Here's the problem with that argument. Central banks are the most informed participants in the global monetary system. They set interest rates. They control money supply. They have access to economic data before it's published. They sit in the rooms where fiscal and monetary policy is debated and decided. When the institutions that literally run the monetary system are converting their own reserves from paper currencies into gold at the fastest pace in 74 years of recorded history, they are telling you something about the future of that system. That their carefully scripted press conferences will never explicitly say, you don't need to mimic their exact allocation. You need to understand their motivation. And their motivation, as clearly revealed by 3 consecutive years of record buying at record prices, is that they trust physical gold more than they trust the currencies they themselves create and manage. If that doesn't give you pause about your own portfolio's exposure to those same currencies, nothing will. And there's a second objection I hear constantly. Gold is at all-time highs. I missed the move. Buying now means buying the top. Isn't it too late to start a position? Here's the reality. Central banks are not buying gold at all-time highs because they think this is the top. They're buying because they believe current prices are cheap relative to where gold is going over the next 5 to 10 years. Every single day they purchase above the previous day's record price, they are expressing a view that gold has significantly further to go. They're not momentum traders chasing a chart pattern. They're monetary strategists with 50-year time horizons preparing for structural shifts in the global financial system. If the institutions with the most information, the deepest expertise, and the longest time horizons are buying at record prices, telling yourself it's too expensive is choosing your personal chart analysis over theirs. You can absolutely do that. But you should do it with your eyes wide open about who's on the other side of that bet. 3 things you can do this week, easiest to hardest. Step 1 takes 30 seconds. Look up your country's central bank gold reserves on the World Gold Council website. See how much they hold. See whether they've been adding in recent quarters. Compare their allocation percentage to the global average. If your own central bank is accumulating gold at record pace while your financial advisor tells you not to own any, ask your advisor to explain the discrepancy. Watch their face carefully when you ask. Step 2 takes 1 hour. Review your portfolio allocation to gold. Not gold miners, which carry operational and management risk. Not gold ETFs, which carry counterparty risk. Physical gold, or physically backed allocated storage where specific bars are assigned to your name. What percentage of your total net worth is in an asset that cannot be frozen by a foreign government debased by a central bank margin called by a broker or defaulted on by a counterparty? Central banks are targeting 10 to 20% allocation to gold. If your number is 0, you're making a bet that you know more about monetary risk than the institutions that control the monetary system. Step 3 requires a decision, and that's why it's the hardest one. If you have 0 or minimal physical gold exposure, start building a position. You don't need to buy everything today at today's price. Systematic accumulation over months is exactly the strategy central banks themselves use. Buy a coin this month, another next month, a small bar the month after. Build a position over time at various price points. The central banks buying 1,136 tons didn't buy it all on one Tuesday. They accumulated systematically and methodically because they understand that the average price you pay matters less than the position you build when you're preparing for structural change. Remember at the beginning when I asked you to drop your gold allocation percentage? Now you've seen what central banks are doing with their own reserves. 136 tons in 1 year, 3 consecutive records broken. 33 to 42% of global mine supply absorbed by sovereign buyers at all-time high prices. 3 historical precedents spanning 57 years, showing that central bank gold accumulation at this pace precedes major monetary disruption. Every single time without exception. If you want to revise your number upward, the comment section is right there. I won't judge. But the central banks aren't waiting for you to decide. So let's land this. Central banks bought more gold in 2024 than any year in 74 years of recorded history. They bought more than the previous record set just 1 year earlier. They bought at all-time high prices, without hesitation, without pause, and without any sign of slowing down. The buying is global, spanning every continent, every political alignment, and every economic development level. The buying accelerated dramatically after Western nations demonstrated that paper reserves can be frozen, seized, and weaponized against sovereign nations. 3 historical precedents show that central bank gold accumulation at this pace precedes significant monetary system disruption. Every time, without exception. They're not telling you to buy gold in their public statements. They're not issuing research notes or recommendations. They're doing something much more honest than that. They're buying it themselves, with their own reserves, at record pace, at record prices. While many of their own economists publicly downplay gold's relevance in interviews and academic papers, the doctor prescribing paper for you while stockpiling metal for themselves. Watch what they do, not what they say. The buying is the message. 1,136 tons is not a hedge. It's not a minor diversification adjustment. It's not a rounding error in a reserve portfolio. It's a statement about what the most powerful financial institutions on Earth believe is coming for the monetary system they operate. They're preparing. The question is whether you're preparing alongside them. One more thing before I go. While researching central bank gold flows for this video, I found a discrepancy in the reported data from one major central bank that suggests their actual gold accumulation over the last 18 months is roughly 3 times higher than their official reports indicate. The gap between their reported purchases and the observable trade flow data, including customs records, refinery shipments, and vault inventory changes, is too large and too consistent to be an accounting delay or reporting lag. Something deliberate is happening. I'm still cross-referencing the data from 3 countries to confirm the full picture. When I have it verified, that's the next video. You're going to want to see which central bank is accumulating 3 times more gold than they're admitting publicly, and what that level of urgency tells you about how they're preparing for what they see coming that you and I haven't been told about yet. Central banks are buying more gold than any year in recorded history. They're buying at all-time highs without flinching. They're buying while publicly telling you everything is fine and the system is stable. The vaults are filling. The records are breaking year after year. The pattern from 1967 and 1999 and 2022 is repeating in real time. The only question left is whether you position yourself alongside the most informed buyers on Earth or against them. The central banks already made their choice. 136 tons is their answer. Most people just haven't read the filings yet. See you in the next one.